Thanks for being here. If you wanted to learn more about Presidio Bitcoin, those are your folks, or certainly myself. Nik, are you ready to go? There you are. Well, thank you all so much for being here. The first timers, the repeaters, and our amazing members. Nik, I got a seat right here for you. It's also your first time being here at Presidio Bitcoin. Absolutely. I know you're on a world tour, and I like to think, and you don't have to answer this question or tell me if it's wrong, but I like to think you saved the best for last.
Why, of course, Alex.
Yes. So thank you for being here. I sort of took my orange pill, so to speak, through the monetary lens, and your book was certainly influential on me. So I'm really excited to hear your latest and greatest piece of writing and thought leadership. So really excited about that. We do have 3 wireless mics. We are live streaming, so if you do have a question towards the end, whenever you're ready for Q&A, we will have some mics that will be passed out. Please just raise your hand so we can record it. But yeah, just a little bit more about Presidio Bitcoin, and then we'll get started. So we try to host events here every Thursday. And you can kind of see upcoming here on board to my left. I'll read through some highlights just because I know it's small and my handwriting is not great. If you are interested in programming and getting into programming, Austin, who's a member here, is leading a class this Sunday. So we'll frequently do those about 1 a quarter. And then we have a really cool builder event. So you don't need to be technical. It's about product. It's about building UI and UX and build products on top or with Bitcoin installed or with it. And then lastly, the last one I'll talk about, which is also extremely cool, being right here in Silicon Valley, how can we create more design around Bitcoin? How can we create more products designed using Bitcoin? So we're having a week-long Bitcoin Design Week here in September. That will be Monday through Friday, the 15th of September. Evening events, Monday, Tuesday, Wednesday. And then if you're really hardcore, there's an application for an all-day Thursday and Friday. So awesome stuff happening here all the time. Really glad that you are all here. And Nik, I think everyone is here to hear what you have to say. And can't wait to get started. So take it away.
Thanks, Alex. It's a pleasure to be here at Presidio Bitcoin. This is a very cool space. So I was explaining to my family that Bitcoin is unique in that you would almost expect as a default there to pop up co-working spaces where entrepreneurs would get together and not even have to collaborate, but just wouldn't mind being in the same room and working on stuff. And I've been to a few places around the country that have really strong Bitcoin entrepreneurial culture. One of them is the Commons in Austin, which maybe many of you have been there. PubKey was very cool to be in, and while it's not a co-working space per se, I would argue that it's a strong home of Bitcoin and a very, very cool place. But this is something special and unique in the world, I would say. So, congratulations to Alex and the founders of Presidio and the members. You guys have something special here, and I am certain that I will be back. This year, I published my second book, Bitcoin Age. In 2021, I published Layered Money, so about 4 years between the two books. And in 2021, when I published Layered Money, there was no book tour. And I did get to speak around the world a few times between that book and this year, but no technical book tour. So this year is my first ever real book tour. It's been amazing to meet people around the country, and it's very cool to always see someone bring their own copy that they've already poured through. So I'm happy to sign the ones that you've brought also, if you have those here. I do want to get into questions because it wouldn't be too interesting to me to just sit up here and talk. So I do prefer the Q&A instead of just ranting about something that you might not want to hear about, like how I wrote each book, or what I think about the Fed today, or power law, or anything of the sort. So instead of me just going off, I think it's just better that we get into it. So,
what do you think of the Fed today? I'm just kidding. You don't have to answer that unless someone else wants to ask it.
all right, we'll start with the Fed. Mostly irrelevant. And the reason that I say that is because my practice is to watch markets. And markets, especially in the interest rate market, those markets are moving all the time. And while the Fed pegs the overnight market with its policy rate, the rest of the market is continually determining the time value of money at every point on the curve, from 1 week out to 30 years. And the time value of money for 5 years or 10 years or 2 years or 30 years, it varies. Now, the curve today is somewhat flat in certain parts of the curve, but it's not the same. Interest rates are different for different time horizons. The 2-year part of the curve, which I watch very closely, is a forward indicator of where the time value of money is going to be, especially that overnight rate over that 1 to 2 year time horizon. So I watch twos. I don't watch the Fed, and I honestly have been ignoring them quite a bit since 2022, when they were late to hike and then overdid it. Since then, since 2022, the Fed has been more or less a non-factor in my analysis. So it doesn't mean I don't pay attention to this stuff. Okay, it's still part of my practice, but the Fed is not something that I'm spending a lot of my first 15 or 30 minutes of my day doing, especially over the last year or two.
I'll ask the natural follow-up, which is, what do you spend the first 30 minutes of your day paying attention to? Or to reframe a little bit more seriously, what do you think is the driver that we should be paying attention to in the current market structure that we're observing?
At the Bitcoin layer, we have built our framework over the last year around an index that we created. It's called TBL Liquidity. The word liquidity is thrown around a lot and takes on 3 or even more definitions. One version of the definition of liquidity is something that you could sell really easily. Like, oh, this asset has a lot of liquidity. It means there's a buyer right there at the spot price willing to take it off of your hands. That's something that's highly liquid. There's another version of liquidity, which is, hey, there's a lot of liquidity in the market today. But that just means there's a lot of money around. It's not a very precise definition. So in my pursuit of determining what are the drivers of the market, because it's not the Fed, what are the drivers, we started to run correlations and started to have this earworm of Michael J. Howell of Cross Border Capital. And he wrote a great book called Capital Wars, which is quite complex and something that we're still trying to work through as a company. In that book and in his framework, he explained to us that liquidity has this other definition, which, from my understanding, is a definition that originated at Salomon Brothers in the 80s on the bond desk. So if any of you have read Liar's Poker by Michael Lewis, he was a contemporary of some of those traders. At Salomon Brothers, his mentor Henry Kaufman originated this idea of liquidity being flow created by the asset side of the balance sheet of the credit providers and the banking industry, basically. So liquidity is what we call on the street, it's sheet. So if liquidity equals sheet, then the size of the balance sheet and the strength of the balance sheet are therefore the creators of liquidity. That is the liquidity. It's the assets of the system and their strength. So getting through, first of all, Joe Consorti interviewed Howell, I believe, 3 times on our program before I got a crack at Howell. And Joe kept telling me, Nick, you gotta get into this a little bit more. And so I did, and I finally brought Michael on and interviewed him myself, but that was after trying to get through his book. And so I basically asked him without asking, hey, what's in your liquidity index? I wanted to understand how he was doing what he was creating, because it was a black box. Then once I read his book, I said, I can build one of these myself because we have a great data provider. So I have the data, so I'm going to build my own liquidity index. And I'm going to put 3 things in it based on my understanding of Howell. Number 1, sheet. So the asset side of the banking system. And by the way, and we're not doing liabilities, M2 or any of that, because it's easy to double count if we do that. So take the assets. Then what are the assets? A lot of them are treasuries. So let's look at interest rates, which is the price of treasuries, and the volatility of treasuries, which is measured by popularly the MOVE index. Let's put rates and MOVE in the formula. So more sheet, more liquidity, lower rates, more liquidity, and lower vol, more liquidity. Because lower rates is higher prices, and lower vol is stronger assets, more stable assets. And the key is if they are more stable, they are more or less easily leveraged. More. And the first version of it had a 55% correlation with the S&P 500, which blew my mind. I was like, wow, that's really strong. And then we added in the dollar a few months later, in that a weaker dollar is stronger liquidity. We can go into that if anybody wants, why that's the case. And it bumped our correlation up to the 70s. So what do we need the Fed for? If we have the market that is showing us whether liquidity is supportive or not at all times. And since April 2nd and the spike in volatility, both in interest rates and the stock market and elsewhere, you have seen an outright collapse in MOVE. And I told my guys today, don't even call it a collapse. It's actually just volatility coming back down. And volatility coming back down means a gentle return of certainty. And what have stocks and Bitcoin done since that moment? They've both gone straight up. So it's working in the micro. That is the driver. It's the center of our research business. And it's not well understood even by us, which tells me there's so much more work to do in research and teaching and explaining.
Who's next? Got another one.
Go ahead.
There are a lot of interesting threads that I'd love to pull on that. I would take, based on that explanation that you provided, that you would be a bull on something like MicroStrategy or strategy, because it's building like a really solid balance sheet that they can use as an asset to go out and acquire more credit, which is broadly stimulative back into the mainstream economy. I would be really curious. I know this is a little bit cliche as a topic of conversation, but based on the theory that you provided there and my general sentiment that that would seem positive, how do you feel about Bitcoin treasury companies at this moment? Like, obviously, they play a role that I think is needed by the market, but it would seem that they are, as a construction at the moment, they look a little bit like SPACs, a couple of years ago, and various things of that nature. So, at any rate, I think I would love to get your thoughts on the phenomenon of treasury companies generally, and maybe the specifics of strategies.
So I'm now going to answer the treasury strategy question with the power law answer every time. The reason is because Bitcoin is a network, and in its growth path, you would expect corporate adoption, sovereign adoption at the right stage as you bring more people and entities into the network. So a natural occurrence that companies are getting involved. What's my opinion of strategy? I think that they will continue to acquire a ton of Bitcoin. I think they might reach 1 million. I think it's quite possible. That's a function of the credit system and their excellent corporate financial engineers. Does that mean it'll be accretive to any of the individual components of their liability and equity structure? I don't know. And that's not my game to play. So I won't be spending any of my time trying to determine if MSTR is a buy or not, or any of the other parts of the structure. It's just absolutely not my game. However, forecasting that they'll be able to increase the size of their issuance across whatever instrument, and then use that capital to buy and acquire more Bitcoin, I can confidently say that that should continue. Other companies doing it, some will be successful. Others will botch the financial engineering and probably cause some volatility. Big four sellers, liquidations. If we think about 3AC and Terra Luna and Genesis and Voyager, that type of domino, that feels like something that could happen one day. And so will I be spending my time on whether corporate treasury strategies are heading for trouble based on their own or individual balance sheet analysis? No. Probably because the market will tell me anyway that it's overcooked or it's not. And I can see those things with market behavior, price action. So it saves me a lot of time. And you asked me, what do I start my day with? I start my day with price analysis. Are the prices up or are they down? And then I go backwards and determine why. But the price comes first. So I'm a price analyst in that I am observing the action of prices changing, the speed, the time, the trigger, the knock-on effect of it, cross-asset correlations. I've been studying cross-asset correlations for 19 years. So that's what I do to start my day. Cross-asset study and price study. And then I'll, sometimes read the news and sometimes I won't.
Hey, I have a follow-on question regarding strategy as well. I guess you are familiar with stretch and stride. So, for example, stretch has a rating that says it's 6x, over collateralized, and I think the other one is 5x or so. I wanted to hear your thoughts regarding that specific, credit score, which is a new, I guess, qualification. Or, yeah, can you elaborate on that?
I can't, because it's a lot of financial engineering that it's just not my field. So I can't. I mean, finance is very broad, right? And I can't have every tool in the bag. And one of those tools is macro. And so in the macro toolkit, telling you whether an individual portion of the tranching out of liabilities is good or better or over collateralized. Well, to answer your question about STRC, you would have to know the prospectus of every other one, right? Because you don't know what the other one says. Who's first loss? I mean, yeah.
Follow on. I mean, don't you think that the market has to do that research just to, like, convalidate the interest rate, which is essentially, there's an implicit rate that is 10.5 if you do between stretch and stride. So it's not the market telling you that, it's well priced.
That's a great question. So the yield should converge. I mean, yields should converge. That's what arbitrage is. So if STRC, for example, maintains a 9% yield for the next couple years, it means they're not attracting enough capital, I believe. If they were, the rate would come down because the demand is up. And so the next 100 million only gets 8.5, and then the next 100 million only gets 8. And I believe that MSTR, the equity piece itself, should reflect what is going on elsewhere in the balance sheet. So pressure on the stock might give you a signal about the rest of the balance sheet as opposed to the asset side. But I'm just not an expert in corporate leverage, right? If I was, I would have taken that job at Jefferies in London where they were doing mezzanine financing, 12 years ago. But it wasn't for me. I don't mean to sound crude, but I actually don't care, like what goes on at MicroStrategy, especially on the within the liability structure. It's not interesting to me. The fact that they are accumulating more Bitcoin is interesting to me, and the capital market around it.
Liquidity at 9.5%, that's 10.5%, that's the implicit rate, is telling me that, the ARP, the equity risk premium, that's the floor, right, for us. So I have to be able to provide a premium on top of that. So to me, that's definitely a proxy. It is important. So just wanted to elaborate on that.
And in New York, actually, somebody asked me, do I feel like STRC is the new risk-free rate because of overnight liquidity at 9%? And my answer to that was only if the capital market shows us that money flows in at that rate and that it does come down. Because unless it's coming down, it means people are not arbitraging it. So that's what you have to look for. Like it's a great yield for 6 times over collateralized overnight liquidity? Yes. Is it too good to be true? Yes. Okay. That it feels like that, but it can't last. If it is too good to be true, it will not last, and you'll have borrow at 4 and invest at 10, and you just rinse it. But that will collapse the spread. Not collapse. It will decrease the spread. So that's how I would watch it. But I don't think that just because they did it at 10 means that should be the hurdle for people broadly to think about. Not that for the individual investor, it might be, because the individual investor might see that investment as the new risk-free rate. But one investor does not make it that. The market will.
Hey, Nick, I got a question. So in your book, you talk about the Eurodollar quite a bit at the beginning, and kind of multi-layered question. Is that one of the reasons why you don't look at the Fed anymore, because the dollar is being created outside of the Fed's control? And how do you see Bitcoin kind of taking over, or if you do see Bitcoin playing a role in kind of what the Eurodollar does right now?
Eurodollar is endlessly fascinating. The Fed doesn't create money, Sean. It's the banks that create it. And so the Eurodollar is a creation of non-US banks, and the dollar today is a creation of US banks. Now the Fed has sponsored a lot of that dollar creation, and you weave in the deficit spending of the US government, and you have this trifecta of dollar creation. It doesn't just come from banks lending. It definitely doesn't come from just deficit spending. And it definitely doesn't just come from Fed balance sheet expansion. It's all of it. But the first line of money creation is a bank loan. You go to the bank, you show them a house that you like. They ask for your income, not in 07, but they ask for your income, you show them, and they say, Sean, we're going to lend you this money for this house. And they create money out of thin air, and they lend it to you. It goes into your deposit account, and you wire it out to the seller of the house. And that seller of the house now has USD that didn't exist before. That's where money is created. The Eurodollar system is that, but without a lot of rules or collateral or treasuries. And so the Eurodollar system is on watch. I firmly believe that the Eurodollar system is under attack from the United States. Couple different angles, but more geopolitically than anything. That the Eurodollar system is now being the US is approaching it with the understanding that if it can tame the Eurodollar system, it can strengthen its own position. Because if a European bank can just create a loan and now you have more dollars in the world, does that accrue back to the nation or the banking or the global banking system? I would argue that it wholeheartedly accrues back to the global banking system and not the country. And so if you tame the Eurodollar system, what you're doing is you're bringing the power of the network effect of the dollar back home. Stablecoin issuers buying US treasuries, what you're getting is a digital dollar backed by treasuries that, whether or not it's on or offshore regulated or even issued, that if the market wants the stablecoin issuer to buy T-bills, you're getting a new Eurodollar system that, even though it's offshore, it's actually accruing back to the US, and that it supports our deficit spending. The Eurodollar system is at fault for many, many things. Most notably, the dilution of the dollar, and also the ability for banks around the world to keep the roll going. And the roll is the rollover of debt. So here's the way I like to think about the Eurodollar system. I gave you the example of the onshore loan, where the money is just created for you to buy a house. But where is the money created in the Eurodollar system? It's actually created to settle a trade. If we're looking at one of the main use cases of the Eurodollar system, BNP Paribas makes a market for a French company that says, I just made a revenue in Indonesia. And the currency we collected local. So we have Indonesian rupiah in our account, and I want euro. And they call BNP Paribas. BNP Paribas they buy the rupiah and they sell you the euro. Well, they have to hedge out their trade, so they do it they call Barclays and they say, do the other side of this for me. And Barclays says, okay. And to settle the debt, they just issue a balance to BNP that says, now here you have $6 million more in your account, and it's just a Eurodollar. So it's just to settle the trade, and they just create the money. So the Eurodollar system is just this creation vehicle for market making offshore. So when Dr. Stephen Myron says 5 days after Liberation Day that the dual public good that the United States has awarded to the world is free defense, meaning we'll protect the world, and you can use the dollar as the world reserve currency in trade between China and Brazil. And what they're saying is that you get to use the Eurodollar system without paying us for it. That's what the dual public good is. Defense, people can understand that the US has Navy ships going around and you can't mess around and find out. That part is easy to understand. But China and Brazil, or France and Indonesia trading but having dollars as their settlement is only because of the Eurodollar system. So the government is saying that cannot be free anymore. You have to pay for it. But how do they make Europe pay to use the Eurodollar system? The banks don't have to pay anything when they issue that loan or make that market, so you have to make it difficult for them to do it by doing other things. Like maybe restrict trade, tariffs, or things like that. Price is truth, right? And what we do in the morning is we look at prices. What has the dollar done for the last 6 months? And if you read between the lines, what they say is tariffs and non-tariff cheating. It means currency manipulation. So when when a foreign country outside of the US artificially devalues their currency, it artificially strengthens the dollar and punishes the domestic producers. So the Eurodollar system is, you can't tax it and you can't stop them from doing it. So you have to attack it in different ways. So thinking about how they're doing it and why they're doing it is part of my current research. And I don't remember any of your other questions, John. I'm sorry.
So is Scott Bessent and Powell best friends with Paolo? Is that a match made in heaven?
Yeah. Paolo is bringing up the next world reserve currency, which is Eurodollar 3.0, something like that.
But with treasuries, hopefully.
Yeah. Tether is something very interesting to think about.
Who's next?
So I think Ray Dalio has this new book out about the debt cycle, the 100-year debt cycle. And I think most people in this room are probably have thought about, Bitcoin as the new sort of like risk-free rate, pristine collateral, however you want to call it. I think there's a hypothesis around, okay, that happens, First question is, how far out do you think that is? How close or far are we from that? And second of all, you kind of talked about this, but stablecoins are kind of like one of the milestones you would expect to see along the way, as you're talking about, like stablecoins replacing Eurodollars, because we want all that origination in-house. I don't know how many years more that buys us, but what other milestones do you see? Okay, next they're going to do this, and then this, and then finally it's like the game's up. Like, so what are the steps on the ladder there you would kind of expect to see?
That's an excellent question. You would really have to see some wholesale change in in the way that non-US banks are able to deal in dollars. So maybe a license, like the Fed will now grant license to issue USD to foreign banks, and that those will be real dollars, not euro dollars. And that bifurcation, that might be something. And your question about pristine collateral, I think Bitcoin is already the asset that has rallied the world around this idea that, yes, we need a better neutral asset and a non-US Treasury reserve asset. Because gold is 10 times the market cap, but has none of the momentum that Bitcoin has. Bitcoin has all of the momentum. And so that rise should continue, but I think it's already here, and I don't think it needs to replace the dollar, or we need to go in some big once in 100-year default cycle or anything like that. I actually think the role can persist. 300 trillion that rolls about a 5-year maturity. So you're talking about every 4 years or so, 300 trillion coming due, or 75 trillion that has to roll every single year. If the world is rolling 75 trillion of debt every year, then do defaults here and there even register on the radar? I think that the role can last a really, really long time. And it goes beyond my ability to, even my desire to project. My daughter is 7. So I'm not thinking about when she's 37. I'm thinking about the next 10 years of her life and ours.
Anyone up here in the front? You got the best seats in the house. There's more space actually here. A couple more chairs.
When a loan gets originated and PNB Paribas says, yeah, we're going to loan you this money to the bank, and or we're going to loan you this money to the house, and they call Barclays, as I said, and then Barclays, you said, hedged out something in a different currency.
So the European example was more about making markets in Forex trading, and the home loan was a domestic lender, so I should have said like a Wells Fargo, creates money to lend to Sean for a house. The hedging out of the FX trade means that one bank takes on for FX risk and then immediately goes to another bank to lay off of that risk so that it's able to execute the trade risk neutral, capture a bid-ask spread, mark the profit, and move on to the next trade.
Pam?
You said in the beginning that the Fed was irrelevant to your analysis. It seems like that there are going to be some rate cuts. So would you be able to say if any of that is going to be interesting to you or noteworthy, or what you think is going to happen this year?
The reason it's not interesting is because the 2-year yield has already told me that it's going to happen, and it might have been early, but it won't be wrong. So 2s trade today at around 3 3/4. The policy rate is around 4 1/4. So the 2-year yield already tells me that short-term rates are coming down by more than 50 basis points. Doesn't mean that it's right. It doesn't mean that it's going to happen right away. It doesn't even necessarily mean it's right. So one of the interesting things that happened to 2s was that near the election, before the election, they were trading below 4 significantly. After the election, they actually went up to tag the policy rate, meaning that the Fed funds rate and the 2-year yield were dead even. What that means is that the market doesn't know if there will be cuts or hikes over the coming 2 years. A lack of certainty around that, or a lack of forward guidance from the market. Meaning the market was unsure. But then, eventually 2s came back down and were trading. They've basically been trading around 4 all year. It means baby cuts may be expected, but not that much. And so that's more than enough signal for me. You don't have to watch the Fed or listen to their nonsense, because you can just ignore the Fed, watch 2s, and then last week you see, they're coming back down again, and then you look at the short-term pricing, and now there's 25 basis points priced in for September. But 2s already told me, so that's the reason why. And one of the charts that we do is 2s versus Fed funds, and what's that spread? If it's positive, hikes getting priced in. If it's negative, cuts getting priced in. And the slope matters. The rate of change also matters too. So those are the things that I watch. The rate of change was extreme, but stocks being at an all-time high with policy rates still at 4 plus means that it wasn't necessarily too high. 5 was probably too high, but 4 doesn't seem too high, especially because the market is handling it very well. Volatility is low and returns are up. If you had asked me 3 years ago, can the stock market survive for 3 years with policy rates above 4, I would have told you no, but I would have been wrong. That would have been wrong. So I don't know what changed. What I can observe is that the economy and stocks have done quite well in a 4% plus environment for quite a long time. So maybe there was a natural rate somewhere that was much higher than zero that the US economy was able to handle.
One of the terms I've seen bandied about a lot on Twitter, and you briefly mentioned when you made your introduction, is the power law. And I was wondering if you can maybe explain what that is and how it relates to Bitcoin for somebody who doesn't know. Thank
Do we
you.
have a mathematician up here that can? The power law is a relationship between two variables and an exponent. And it's something that we can observe in nature. So one of my favorite examples that helped illustrate this to me from Dr. Giovanni earlier this year was about the relationship between an animal, its mass, and how many calories it has to consume. It's a non-linear relationship, meaning that I'm going to make up a couple numbers here. If an elephant is 10,000 times the mass of a mouse, does it have to eat 10,000 times the amount of calories as the mouse to survive? No. It's less than 10,000 times. And if we plot this curve, this relationship between animals, the mass of animals and the amount of calories that they have to consume, it follows a power law in that if you apply an exponent, whatever the exponent is, you can see the plot holding this power law, right, to the power of, as in power law. You can also observe this in the growth of city populations. So in the beginning, the growth is extreme and then it levels off, but it's still growing. And that relationship is it has to do with whatever exponent properly describes this relationship. So when observing Bitcoin's price versus time, there's a power law. The exponent is somewhere around 6. This was fascinating to me because I like math, so the statistical relationship was really fascinating. But then the moment happened that broke my brain forever, which was during my interview with Dr. Giovanni. He explained to me that the exponent of 6 is a product of 2 and 3. There are two separate power law relationships going on in Bitcoin. Bitcoin's address growth is the square of time, and the price appreciation is the cube of the address growth. So a square and a cube, 2 times 3 equals 6, and the time and price, which have a power law of 6, is actually a product of 2 separate power laws.
Oh, that's all.
We're gonna do much more work on this at the Bitcoin layer, because it resonates with me. I mean, I actually feel it to be true, and your gut knows. So my gut tells me that it is the power law theory is something that I should believe in. It makes me answer the Treasury strategy question flippantly in that, yeah, it's just a product of the network's growth. So of course it's going to get to the point where more people and companies buy it because it's following a power law. So that little breakdown of the exponent being a product of 2 different power laws was the moment for me that I couldn't unsee. So it'll be the focus of my research, I'm sure, for months and maybe years to come. And Jeffrey West's book, Scale, which was recommended to me by Dr. Giovanni, is next on my list. And I saw it when interviewing Dr. Stephen Perrineau last week, or on Monday morning. I saw it on his desk right above which book? Michael Howell's Capital Wars. So if you want to know where my brain will be for the next year plus, it will be with those two books.
Was your book on top of that stack as well?
I gotta shake down Steven and ask him where it was. He's in Asia, so I don't know if the Amazon is shipping there yet.
Thanks, Nick, for being here. And so, I'm a recent graduate of the other side of town. I didn't have a chance to take your course. I know. Go Trojans, I'll say it once. What do you hope, the next generation, whether it's the high schoolers, some who are going to college graduates, take away from, your expertise, and what do you hope to share with them as they consider both macro, micro, and state of the economy things?
They gotta ask the right questions. And they can't just be unaware of what money is and what banking is and what their deposits are. And if they're going to earn dollars, what are those dollars that they're earning and where do they come from? You have to ask the question. If you don't, you're gonna miss all of finance. So as a finance teacher, I just have to get them to start asking the right questions. And at the end of my 4-week term, I asked every student, what was your favorite lecture? And almost every single one of them said layered money. Because I didn't ever think about what is money or the difference between currency and credit and cash and money. They just didn't ever think of it because you're not taught it. I took AP economics in 11th grade and world politics in 10th grade and started at USC Marshall School of Business. Nobody teaches you that. It's not taught at all. That's a big problem, and it's probably on purpose. Thanks, Kyle.
Well, I'll do another one. So there's more and more like fiat Bitcoin, right? I feel like it started this cycle with the ETFs, and we have all your treasury companies, and then we have 401k, and then, So the elephant in the room, in my opinion, is like 6102, right? What do you see, like, just riff on that a little bit? What's the risk of like they saying, okay, it's Sunday morning, you wake up, they're like, everyone gets Friday night's closing price, and then thank you for your donation.
It can't be ruled out. I'm a big believer in precedent. I'm also an optimist and a big believer in the First Amendment, the Fourth Amendment, both, the Fifth Amendment. All three of those amendments matter a lot for Bitcoin. Speech, privacy, and the right to not self-incriminate. Even the third amendment, which is, soldiers quartered in your home. Like all of those really matter, I think, and we have to fight for our rights. So I respect the Executive Order 6102 because it's history and I respect it. and I value the Bill of Rights and separation of powers. So it's not a foregone conclusion one way or the other. You're gonna have to fight for it. We're all gonna have to fight for it. Promoting Bitcoin as a First Amendment, existence is important. So I try to do that. It's in Bitcoin age that the First Amendment matters too, but so does the Fourth Amendment. I mean, these things really do matter. And we have time for one more, if that's okay. We had two more.
I just had a natural follow-up on that series of comments that you made there. Given kind of the dangerous trend that we saw over the last 2 weeks with legal cases, or specifically targeting privacy technology in the space, which of course contradicts the current guidance from the DOJ and the Blanche memo under the current administration. And your comments just a moment ago about the importance of defending these rights. I'm just curious what comments you would have for either, I don't know, take it at the level you want, either regulators and people who are like, seeking to understand why they should allow privacy technology to exist in Bitcoin, or to Bitcoiners everywhere about, how important it is for us to be fighting for these rights, or anything. But just given how notable that was over the last 2 weeks and your comments just now, I'd love to hear your thoughts.
Privacy in the digital age is a slippery, existence. It almost doesn't exist. And so once somebody transacts in Bitcoin, you're opening yourself up. So I'll just say that I like to follow the legal cases and the appeals, and I don't have a great forecast there. But I do believe that once you transact your Bitcoin, I don't want to say that you lose your rights, but I can see the legal battle much more clearly from the other side once you transact. I'm pro-privacy in that I would hope people have private ways to transact their Bitcoin, but I'm not convinced myself that the government will let people do that. Americans can find a way, doing things legally also.
Yeah, so just for those of us that are less technically trained, how do you see the concept of layered money evolving if and when Bitcoin becomes the base layer for global settlement now that you see the Fed as being irrelevant?
So the Fed irrelevant in that its movement of short-term interest rates is a lagging indicator. The Fed, as a central bank of the United States and being the shepherd of the currency and the credit system, is not irrelevant. It's a fixture. And they can easily dilute the dollar at any time. They're irrelevant for me now because they're not engaged in any of that, nor does the economic situation warrant speculating about what they might do. Layered money evolves in a way in which large debts will be settled in Bitcoin terms, and full stop, because that's the definition of money, what settles debt. So this morning I was doing some research on legal tender laws. The King of England in the 13th century made it law that you must accept his coin to settle debts. And for the first 100 years of the United States, you had a free-for-all monetarily. And it wasn't until the Civil War where we got legal tender laws. So how do I see layered money evolve? Bitcoin becomes the de facto tender to settle debts in any global situation. Sight unseen. Sight unseen meaning you have a node and you can verify it, but without having to force legal tender laws on others, emergent from the market. Thank you guys so much for your time today. Really appreciate it.